Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his good friend and expert on the channel, Dana from Henlane. How you doing, Dana?
I'm great. Thanks for having me again.
I love your willingness to give back and tackle a topic that, frankly, a lot of CEOs may not have been willing to do, right? We obviously, both you and I in the Silicon Valley, we've been around a long time. And, winter is coming. Winter is here in the Silicon Valley. We have seen the public markets hammer, right? We saw Snowflake just yesterday beat earnings, beat revenue, give a weaker guide. Their stock's down like 15% after being down like 60% or whatever it was. So I'm assuming public companies are their daily marks for private companies, right? Henlane is a private company. You obviously have investors. I wonder what is going on in that. I'm guessing you're feeling it. I know you're watching it. But what's going on? What's the story?
Yeah, so it's actually really interesting. Just to kind of back up there, one thing I hear is this whole debate of, hey, are we in a recession yet? We haven't officially hit that 2 quarters of negative GDP, but are we in a recession? And if you talk to someone who's not in Silicon Valley, they're like, not yet.
Yeah.
And we're here where we are, everyone's like, are you kidding me?
Yeah.
Of course, we've already hit this, even though
the
actual numbers don't define it.
Yeah.
And so from what we're seeing, and kind of what we've seen is it's primarily on valuation. So if you go back to, and Michael, you called it before anyone else, you had said inflation is much higher than even it was reported. And this was in the early days of just when inflation started to rise. What happens is the stock rates, typically they go in the opposite direction as interest rates. So interest rates had to rise to counter the high inflation rates. And so what we saw was stocks starting to get corrected. If you are a valuation stock, and what I mean by that is it's based on your revenue right now and your cash on your balance sheet, et cetera, you actually don't get hit as hard. The companies that get hit the most are the public companies that are based on growth, future growth and potential. And those are the ones that get hit the hardest. And so that's why Silicon Valley is feeling it the most, because most of these companies have these valuations that in the public markets, and then I'll talk about the private market. In the public market, it's like 30x ARR is what we were seeing. So in other words, their valuation was 30x of what their annual recurring revenue is. So if you take your revenue now for this month, times it by 12, if you're a software company, that was a valuation. And so what was happening was the public market said, nope, interest rates are rising. And so the companies that are going to get hit the hardest and we're going to have to adjust are those growth stocks. And all those growth stocks are all the Silicon Valley tech ones where they don't have that revenue. It's the future promise of that revenue based on the growth. And so how is that affecting us?
Let's go back. I mean, let me just break down this first one, because I think the public market is something all of us, if we paid attention to, we could watch it, right? We know, or at least with a very quick research, you could figure out which cloud-based software companies are valued at 30x ARR, annual recurring revenue. What is interesting is really as interest rates went up, what I believe we saw was a quick recalculation of risk. We went from risk off to risk on, right? There were some cloud unicorns who were 100 times ARR.
Yeah,
that is stupid, right? There's a podcast called the All In Podcast. You may or may not have heard of. One of their investors, David Stacks. Anyways, one of them is a cloud-based event like investor. That's what he does. He always talks about ARR and all of this. And he's like, guys, basically I think it was about 3 months ago, he started talking about public marks reaching the private market. And really what he was telling his companies is, we're telling our CEOs, such as yourself, folks, go get your burn rate in order. Go figure out what your cash is. Go look at your burn rate. If you have to raise now because the window's closing. And if you missed it, right? That's what we're seeing now, right? Even public companies like Carvana, right? A unicorn of all unicorns, whacked. They had to reduce their burn rate because raising more money is going to be hard. So I think what we win is from risk off to risk on. And if you're not making money, like you're losing money every quarter and you're paid for growth, but you don't have enough cash or reserves, you go to zero, right? That's how the .com went bust. You and I remember that time frame.
Yeah. Well, and I think actually the David Sachs one is a really good point, because so when we raised our round of funding, which we raised in October,
Good timing.
Everyone, great timing. All these investors were asking, what's your revenue growth? That's all they cared about was revenue. Now, every single prop tech, so founder and real estate who goes out there, what they hear is, what's your burn multiple?
Mm-hmm.
And that's the only question they get, which is basically your net burn, how much you're burning versus your growth, your net new ARR. And they're saying it's not okay if you're growing, 10 to 20%, but you're burning so much to get there. That's not a healthy company.
No, it's hard to get escape velocity.
Yeah. And so suddenly they're really resetting it from that perspective. And I think it's good. I think it's really good for our industry to have that, because these multiples, 100x, you're right on ARR, that's a huge risk to take it on these companies, especially in a public
do you think that's you think?
Yeah, well, you're thinking, and I was talking about this last night. We had an investor over for dinner at VC, and we were actually real estate prop tech, and we were both talking about this of, by the time you get public, you kind of have to have things figured out, like your gross margin. You just have to get that figured out. You have to understand, like, hey, at what point do we get to profitability, or do we stay, sort of at net zero and continue to grow? But a lot of these companies went public that were tech companies that had none of this figured out. And so now you're seeing these huge corrections. And now, what we're seeing with these valuation multiples is they're at 5 to 7x now. And that's reasonable for ARR.
Yeah. Well, I think, again, I don't know why the .com crisis won't repeat this time. There will be some companies that won't exist. Mm-hmm. They'll either go bankrupt or dissolve, or in many cases, they'll probably get bought for their customer base or IP or whatever. There'll be a feeding frenzy, because again, there are a lot of CEOs and executives who are focused on the top line. It's all about growth. We're going to grow our way out of it, all of that. They are not paying attention to the burn rate. I believe the number one metric that kills any company, and frankly, any family from a money perspective, is not the income statement, not the balance sheet. It's cash flow. Mm-hmm. You can go bust with growing revenue and growing profit if your cash flow is not right. And a business that's based on a repeating monthly business, that can be a problem, right? You can have customers today that don't pay tomorrow, and your cash flow just goes to zero. And, pretty soon the oxygen's turned off. I don't think enough CEOs look at the cash flow statement. Yeah,
no, I completely agree. And I think this is a good reset for the tech industry. And I agree with you. This is going to be more like the .com bubble that we saw versus what we saw in 2008 with housing. Mm-hmm. I think it's going to be very similar to that. And so some people may not feel it as much as others. And that's why you and I are feeling it a lot more, or hearing it a lot more here in Silicon Valley. And our friends there are like, wait, what? I haven't heard this. I know inflation. I've definitely seen that, but I haven't seen anything else get impacted like we're seeing here.
Yeah, that's really interesting, because again, David Sachs talked about, he thinks a recession is here already. And I think it was Monday I made this comment. I'm like, David, I get it, right? We're both in the Valley. It's definitely recession-like in the Valley. But again, I have a national channel now, and I can tell you the rest of the country is really not there yet, at least from a recession, consumer, retail spending, all that. I think a recession is coming. It's just we're feeling it first. This is so much like the .com crash or correction, or whatever you want to call it. It's 20 years on repeat. So it's pretty interesting. I would love to talk in our next session about who you think gets hurt in this. But people want to go play with your 30-day trial. They want to go visit, it's hemlane.com, right?
Yep. Hemlane.com. If you're looking for property management, anything from, software to 24/7 repair coordination, go to hemlane.com. And we won't be one of those companies that has a fire sale from that. We do look at that burn multiple.
Awesome. Yeah, we're going to talk about who's going to get hurt and why Hemlane won't be one of them in the next episode, at least in my opinion. Thanks, Dana.
Thanks.